Picture this. You finally decide to take control of your financial future. You download an investing app, put your hard-earned savings into some solid companies, and wait for the magic to happen. But then, it happens. You open your phone and your portfolio isn't green. It's a deep, painful red. -5%, -10%, -20%. Every time you check, it feels like your money is just evaporating into thin air. Suddenly, your social media feed is a nightmare. The news is screaming about imminent crashes, looming recessions, and market corrections. The panic starts to set in. Should you sell everything now before you lose it all? Should you just delete the app and cry? Before you make a move that could haunt your bank account for decades, you need to hear this. Throughout history, market crashes have been the single greatest creator of new millionaires. While the masses are panicking, a small group of smart money investors are looking at these red charts as a once-in-a-generation clearance sale. This might actually be your best chance to become wealthy, but only if you know the rules of the game. In this deep dive, we aren't just going to talk about why the market is falling. We are going to explore the mechanics of market crashes, how to identify if a downturn is normal or a true catastrophe, and most importantly, how some people manage to profit massively while everyone else loses everything. If you want to turn market chaos into your biggest win, let's get started. Section 1. The 3 Horsemen of the Apocalypse. Why markets crash. To profit from a crash, you first have to understand the why. A stock market crash is defined as a sudden, rapid drop where a vast majority of stocks fall sharply in value. Generally, these events are triggered by 3 specific catalysts: bubble bursts, economic decay, and black swan events. The hype monster. Bubble bursts. A bubble occurs when the price of an asset, in this case stocks, skyrockets far beyond its actual value. This isn't driven by business growth or profits. It's driven by pure hype and the fear of missing out. Eventually, investors wake up and realize the emperor has no clothes. They start selling, and the price collapses. Look no further than the infamous dot-com bubble of the early 2000s. The internet was the new frontier, and investors were throwing millions at any company that simply had a .com in its name, even if they had zero profit and no business model. At the peak, over 400 internet companies went public, and the tech-heavy NASDAQ index surged by over 800%. But reality eventually popped the bubble. The NASDAQ crashed nearly 80%, wiping out trillions of dollars in market value. It actually took 15 years for the index to return to its pre-bubble price. That is the power of a bubble. Hype inflates it, but reality always pops it. The economic engine. Recessions and interest rates. The second reason is a failing economy. When inflation runs rampant, the cost of food and rent goes up, and people naturally spend less. When spending drops, business sales plummet. When businesses make less money, investors expect lower future profits and sell their shares, pushing prices down. If this cycle continues, it leads to a recession, a period where the entire economy shrinks and production slows down. This is where the central bank steps in. To fight inflation, they raise interest rates. This makes loans more expensive for businesses, forcing them to cut production. Every time the central bank announces a rate hike, investors get nervous. High rates mean expensive debt and lower stock prices. Lower rates mean cheaper loans, more business growth, and typically, rising stocks. The unthinkable. Black swan events. A black swan is a fancy name for an unexpected disaster that nobody saw coming. These include wars, pandemics, attacks, or massive financial scandals. These shocks cause immediate, widespread fear. The best recent example is the COVID-19 crash of 2020. No one predicted a global pandemic would shut down the world's borders. Within a matter of weeks, global markets fell by over 30% as investors panicked about a total collapse of the world economy. While there are other factors, like excessive leverage or herd behavior, these 3 remain the primary reasons the market suddenly turns red. Section 2. Is this normal? The hierarchy of market downturns. Here is a secret that most new investors don't know. Stock market crashes are completely normal. The market doesn't move in a straight line, it moves in cycles. If you are a long-term investor, you have to accept that these downs are just as much a part of the game as the ups. In fact, for professional traders, These dips are the only way to buy low and sell high. To stay calm, you need to recognize the 4 different levels of market downturns. Pullbacks, 5 to 10% drop. These happen almost every year. They are just regular breathers for the market and are considered perfectly healthy. Corrections, 10 to 20% drop. These usually happen every 1 to 2 years. They occur when investors realize stock prices have become slightly overpriced and correct them back to fair value. Bear markets, 20 to 40% drop. These happen roughly every 5 to 6 years, usually triggered by an economic slowdown or rising interest rates. Crashes, 40% plus drop. These are the rare, once in a decade or two events. They are usually tied to those black swan events or a major financial crisis. The history of resilience. History has proven, without exception, that the market eventually bounces back and reaches even higher peaks after a crash. In 1973, an oil embargo sent markets down 50%. It took 7 to 10 years to recover, but recover it did. In 1987, on Black Monday, the New York Stock Exchange crashed 22% in a single day. It was back to normal in 2 years. In 2008, the global financial crisis caused the S&P 500 to crash nearly 50%. It recovered in 4 years. In 2020, the COVID crash saw a 30% drop in just 5 weeks. Yet the market fully recovered in just 4 months. In every single one of these scenarios, the outcome was the same. The market fell, and then it came back stronger. So who lost money? The people who panicked and sold at the bottom. Who got rich? The people who stayed calm and held on to strong stocks. When should you actually worry? People often argue that past performance doesn't guarantee future results. While true, there are clear signs to watch. If businesses are still operating, people are still spending money on leisure and essentials, and the government is taking action to stabilize the system, the market will likely recover. This is especially true in large, stable economies like the US. You should only truly worry if the entire economic foundation breaks. We're talking about banks going bankrupt across the board, people losing all access to their cash, and the country defaulting on its debt. These situations are extremely rare, but they are the only time a crash is truly different. Section 3. The Millionaire's Playbook, How to Profit. A market crash is essentially the stock market going on a massive sale. As the legendary Warren Buffett famously said, "Be greedy when others are fearful." If you want to join the ranks of those who build long-term wealth during a crash, you have to avoid 5 critical mistakes and adopt 5 professional strategies. The 5 wealth-killing mistakes. Panic selling. When you see red, your instinct is to sell to save what's left. But remember, you haven't actually lost a single cent until you sell. If you own strong, profitable companies, they will likely recover. Selling at a loss just makes that loss permanent. Timing the bottom. Many people wait for the perfect lowest point to buy, but nobody knows where the bottom is. If you wait too long, you'll miss the recovery. If you buy too soon, you might see further drops. Buying trash stocks. Just because a stock is cheap doesn't mean it's a bargain. Some companies fail during a crash and never come back. Concentration risk. Putting all your money into one sector, like just tech or just crypto, is a recipe for disaster when that specific sector gets hit. FOMO herd mentality. Following the crowd, whether they are buying or selling, is usually a mistake. Professionals don't follow the crowd, they follow the research. The 5 pro strategies for growth. Focus on quality. Only buy companies with low debt, solid earnings, and a history of surviving tough times. During a crash, these great companies become cheap simply because people are panicking, not because the business is bad. The Amazon case study. Before the 2008 crisis, Amazon was around $90 per share. During the crash, it dropped below $40. If you had $1,000, you could have bought 25 shares at the bottom instead of just 11 shares at the peak. By 2021, those shares were worth over $3,000 each. That $1,000 investment would have grown into over $75,000, a staggering 8,000% growth, because you bought a quality company at a discount. Dollar cost averaging, DCA. Instead of trying to time the bottom, invest a fixed amount of money regularly, for example, $100 every week. This way, you automatically buy more shares when prices are low and fewer when they are high. It removes the stress and ensures you are accumulating throughout the crash. Diversification. Spread your money across different sectors like healthcare, tech, utilities, and consumer goods. If one area takes a hit, others can balance it out. Use funds. If picking individual stocks is too hard, buy ETFs or index funds. These automatically spread your money across hundreds of companies, reducing your risk of a single business failure. The short game, professional only. Some pros use short selling to profit as prices fall. This involves borrowing a stock, selling it at a high price, and then buying it back later at a lower price to return it. While some have made billions doing this, it is extremely risky, and I don't recommend it for beginners. Conclusion. The final word on resilience. The stock market is a device for transferring money from the impatient to the patient. A crash feels like the end of the world when you are in the middle of it, but history shows it is actually a recurring cycle. The US market has survived every single disaster thrown at it for over a century and has always reached new highs. The secret to winning isn't having a crystal ball. It's having a stomach strong enough to handle the volatility. If you stay calm, avoid panic selling, do your own research, and focus on buying quality, you can turn a market crash into your biggest financial victory. Never invest in something you don't understand, and never blindly follow the crowd. When the next crash happens, and it will, don't fear it. Be ready for it. If you found this breakdown helpful, make sure to like the video and subscribe so you don't miss our next deep dive into building wealth. Thanks for watching, and stay invested.